Throughout millennia, gold has always benchmarked a true value of all foreign exchange currencies as they came and went. And once they were meddled with, each and every single currency failed.
They now have to keep printing or we crash.
We've got this ticking time bomb.
Talking gold with the one and only Andrew Maguire.
Welcome to Live from the Vault.
Welcome to Live from the Vault, the show that goes beyond the headlines and uncovers the truth about the precious metals industry and the effects on the global economy in these historic times. We have exclusive interviews and access to experts and insiders, and we reveal information and insights that you simply won't find anywhere else. Hi, my name is Shane Morand, and I'll be your host for this week's episode, and we'll be joined shortly by the one and only precious metals expert and whistleblower Andrew Maguire as we pull back the curtains on the intricate world of the gold and silver markets and expose what's really going on in the precious metals industry. And get ready for another blockbuster episode of Live from the Vault right here, and we'll bring you the knowledge and the understanding that the mainstream media just won't provide. And with that, let's head over to the UK and talking gold with Andrew Maguire. Hey, Andrew. Look, we've had a lot of positive feedback from our last market updates only 2 weeks ago. It seems like a lot longer, but you really connected the paper market to the physical footprints in that market. We talk about it all the time, but you really connected it 2 weeks ago, and we had a lot of questions and a lot of positive feedback, which are leading really to the central bank driven gold market revaluation that you keep talking about over and over here, but it's coming to a head, and how the Fed in particular is severely behind the curve in this process. Maybe we can start this episode off by giving us an update on what you're seeing exactly on that topic.
Yeah, Shane, it's great to be with you again and great to be with our subscribers again. And yeah, absolutely. This is history in the making. And there's no doubt that a gold market revaluation is inevitable and imminent. And it's the Fed that's running out of the tools to keep what we call the synthetic cap on gold. And the same acts, of course, in silver, into an increasingly liquid global physical marketplace. Now, that was never envisaged when the COMEX was set up. Now, this week, and based upon direct, up-to-date, first-tier liquidity provider feedback, we'll take a look at how the Fed's sole remaining tool to cap gold, which is the COMEX Futures Exchange, is running out of sufficient liquidity to maintain the 50-year synthetic hedge against the Fed's massive borrowings of derivative gold, and how this has to be resolved by way of a capitulative third and final historic US dollar gold price revaluation. In the past, we went through how the other two were implemented. Now, this time, we're actually looking at a price revaluation from $42 an ounce. Now, the implications of this are enormous, and we need to be ready. The focus should be primarily about wealth preservation, and we're evidencing a very small window in which to take the action. And while every other global central bank has been openly accumulating physical gold alongside very large allowable undocumented tonnage purchases of undisclosed monetized gold, which does not have to be listed, and that's been primarily Russia, China, and some of the BRICS plus jurisdictions, it's clear by the divergent and increasingly globally arbitraged COMEX market footprints that the Fed is the sole remaining outlier, the lone central bank still attempting to contain and delay the inevitable gold price revaluation process. We can see that. You just have to look at this week's action, and you can see how they're still trying. However, what we do see, though, is the Fed faced with dealing with massive rehypothecation, i.e. double ownership claims, on the listed 8,133 tons of pledged treasury gold reserves that they look after. And, they're now aware they're on the back foot. And as liquidity to maintain the paper gold illusion evaporates to unsustainable levels, the Fed is as disruptively as possible trying to exit these extremely large, wrong-footed, undeliverable derivative market long dollar bets which have been made against gold. And long dollar is a fiat currency against gold, which is a physical product, which they're largely aggregated in the non-Basel III compliant, US-centric, COMEX-centric, cash-settled gold futures markets. Note cash settled. Now, these synthetic derivative bets against gold have relied upon creating and upholding and maintaining a synthetic price manipulation structure contained inside the COMEX exchange. But their actions are actually catching up against an increasingly liquid physical exchanges around the world. Telegraphing these efforts to contain gold by synthetic means are on a slippery slope and measurably failing. As this situation presents an opportunity, our focus is on exactly where we are in the competing, globally driven, physical gold driven revaluation process. Clearly, that is what we're trying to focus on. Firstly, because it defies logic, especially for those that mistakenly perceive the Fed is actually a government organization versus the cabal of self-serving private banks that are calling the shots. Let's look at how and why the Fed got into such an untenable position, and then we'll look at the unraveling of the remaining tools in layman's language.
Now, hey, Andrew, thanks. But now here's what I wanted to ask you. Just before we started recording, we were chatting about how wide the divergence is between the paper gold and the physical gold is being stretched like crazy. Now, we're over 120 episodes of Live from the Vault, and I know that since the very first episode, you saw this coming. You kept on calling it over and over as we continued here. Where are we right now in this process?
Yeah, Shane, and let's start by looking how the Fed, or should I say this self-serving cabal, got into such an untenable situation. So 50 years ago, before Nixon closed the gold convertibility window, the value of all foreign exchange currencies, of all foreign currencies fixed against the dollar, were expressed in a physical gold price. It's that simple. However, due to excess money printing, does that ring a bell by chance now? But it resulted in a dollar surplus and that had exceeded the ability to back the dollar with gold at the congressional set fixed price of $38 an ounce. That was the exchange price. So fearing dollar devaluation into what was a stagflationary condition, again, ring a bell, global central banks raced to exchange their rapidly depreciating dollars for higher value US dollar physical gold reserves. And back then, the Bretton Woods Agreement had provided central banks holding dollars the right to exchange these dollars at will for a fixed amount of gold, which was priced at the time, as we say, by Congress at $38 an ounce. So at risk of the remaining US dollar gold reserves being fully drained, undermining the balance between what would be an increasingly unbacked gold US dollar, unbacked US dollar with gold, but flowing into an increasingly physically backed buyers, central bank buyers, which is of course supporting the foreign exchange benchmark of the exchangeability of this. The growing threat facing the US dollar hegemony forced Nixon to slam shut the Bretton Woods Agreement. Now, we all know this is history, but a lot of people have not actually looked at this before and are puzzling how come this official government agency could possibly be so wrong-footed. Well, we're going to go through that. Throughout millennia, gold has always benchmarked a true value of all foreign exchange currencies as they came and went. And once they were meddled with, each and every single currency failed. And so, as is the case now, will fail again. So cut a long story short, Nixon removing a fixed exchange price for gold did not halt the gold outflows, as global gold assets continue to be valued in real time, only at a much higher price, against the dollar in the foreign exchange market. So nothing changed. So with gold continuing to be traded against the dollar in the global foreign exchange markets, driven by global central banks willing to pay a higher price to market, at a mark-to-market price as determined by supply and demand, and obviously, and a real market price for deliverable gold began to emerge. Does that also ring a bell? It should. Despite Nixon's effort, the dollar to gold conversion process continued unabated. That's what happened. And despite the gold price being revalued to $42 in 1974, you think that stopped it? No, it didn't. Global central banks continued to redeem dollars for gold on a wholesale level. So losing control, something had to be done by the Fed to alter to halt the drain of US dollar gold reserves. So physical gold outflows became the trigger point for the Fed to cobble together a gold futures derivative contract and list it on the COMEX futures markets. So on the 31st of December 1974, gold was integrated into the 1933 formed COMEX futures markets. Now, the primary purpose of adding a gold contract into the COMEX futures market was to inject sufficient official synthetic undeliverable paper gold supply and to deliberately inject unnatural gold price volatility, as would be necessary to dilute and control the price of foreign exchange gold. This is what it was all about, foreign exchange gold. And what had happened was, for the first time in gold's over 5,000-year history, the Fed had created a facility for a global gold market to be heavily leveraged on a wholesale level, and was admitted, it was admitted by Congress at the time. Cash-settled futures trading provided the Fed the tool to be able to inject virtually unlimited volumes of cash-settled paper gold to dilute the real gold price. This is what it was about, diluting the real gold price. In other words, by deliberately obscuring official supply-demand fundamentals, the Fed was able to convert real deliverable physical gold into a highly leveraged 100-to-1 unbacked cash-settled fiat gold currency. And this was the start of a 50-year slippery slope. And fast forward to now, ultimately, we are the beneficiaries of this. And while the Fed denies intervening in the gold markets, they do openly admit actively cooperating with other friendly central banks to intervene in the foreign exchange markets. That's dollar gold, that's pound, euro, dollar, yen, exactly, and all of the other crosses. But that includes gold and silver. So with sleight of hand and an unlimited ability to print dollars by converting the physical gold market into just one more unbacked fiat currency, for the ensuing 50 years, they were able to surreptitiously manage the cash-settled gold price. Note, while gold was able, it is to be cash settled. But on the first trading day of 2023, as we said at the time, Basel III NSFR compliance turned the 10 times larger spot gold foreign exchange market into a fully deliverable, physical deliverable contract, which had to be backed by physical. Now, global central banks realized this had reopened Nixon's dollar for gold exchangeability window, exposing the back door of the otherwise cash-settled COMEX exchanged EFP mechanism. We talked about that before. That's just simply a mechanism in the COMEX where you can transfer an undeliverable cash-settled contract into a deliverable contract. So it created this back door. And so we saw this unfactored physical outflows going into Basel III compliant, fully physically backed spot gold delivery markets. Now, the COMEX EFP backdoor is providing global central banks, friendly and unfriendly, that is, a window for competing central banks and sovereigns to capitalize and force delivery of the COMEX derivative gold price. That's a huge deal. That was not available before the 1st of January. Hence, under the smoke and mirrors leverage, the drain of lifeblood COMEX paper market liquidity began. And 6 months in, now, here where we are, into gold being revalued as a first-tier asset, gold has only just begun to be more widely noticed by Western traders, certainly been noticed by Eastern traders. Now, while this means that the ability to utilize the COMEX EFP conduit to siphon off previously undeliverable cash-settled COMEX gold into the compliant NSFR compliant spot market, has now constrained the Fed's ability to generate unlimited quantities of synthetic gold, which is why the COMEX was set up in the first place. They're now limited to what can be squared up against the speculators contained inside the COMEX casino walls before it leaks out. However, inside the siloed casino, an increasing number of speculators have realized that gold actually has been reclassified as a first-tier asset class, competing with cash, bonds, etc. And so they're diversifying. So there's a group of speculators using that to diversify, adding gold as a risk market hedge along with other hedges. Hence, we're evidencing an important structural split in this category of traders that the Fed has relied upon to create an endless paper-settled market.
Yeah, Andrew, with Basel III, we get a lot of positive feedback. I think you were most likely the first, and we can go back and look at Live from the Vault, but the first to start talking about this. And they're thanking us for really lifting the lid on this important split as imposed limits and how much paper gold could be injected into the COMEX. But there's a lot of interest was shown when you drew attention to some of the price capping tools that the agent banks disruptively employ to keep a lid on gold. Now, to answer a lot of our subscriber questions, where are we with this?
Yeah, Shane, great question. And really, when we get to the end of this, I think I'm going to mention my work with Basel IV, which is going to be, I think, something really people need to sit up and wait and take notice of. So if we just fast forward to now, and utilizing the primary tools that we outlined, as you just described, and made public in many of our Live from the Vault episodes, let's take a look at the resulting setup in simple layman's terms and take advantage as these induced paper market conditions slide down the slippery slope and force this gold price market revaluation. So following the COMEX scam starting to clash against the 10 times larger foreign exchange markets in 2013. Now, a lot of traders will remember this. And what it did, it exposed, the result of it clashing was because it exposed the European LBMA first-tier gold banks actually failing to deliver on a whole raft of customer physical withdrawal requests. Now, the tip of the iceberg was ABN AMRO, on the 1st of April 2013. In fact, it was one of our clients that sent the letter saying, look, they're refusing to give us delivery. They want to cash settle. So this was their bullion. And then it turned out, we published that letter, and then it turned out there was a whole raft of them. Not only that, there was other banks actually pulling the same stunt. So what had happened was large cracks had appeared in the coordinated CME COMEX LBMA paper settlement game, which rely on each other. This is they Tweedledum Tweedledee. They rely on it. And so the crack in the paper game resulted in a hastily called April 2013 meeting with the Fed summoning all the first-tier LBMA market-making gold banks into a private meeting. And then, no coincidence, the very next day, a coordinated bid-pulling effort commenced from the 3rd of April all the way till April 2015, 2 solid years, synthetically coordinating a $550 completely disingenuous crash in gold prices. This was a setup, and it was a panic move, and this enabled the Fed to consolidate their position short term, but to rig prices going forward. This same cabal of self-serving private bankers also banned US traders from accessing the 10 times larger deliverable foreign exchange markets, which had caused the problem in the first place. Now, these band-aid solutions succeeded in siloing sufficient synthetic global trading volume back inside the rigged casino, the 95% win, 5% win-lose casino environment. Hence, we refer, and you often bring it up, Shane, why we call the COMEX a casino. So really, once siloed back inside the casino, these insiders installed an internal cabal of casino pit managers. What do we call them? Global market makers, but who still maintained a footprint in both the foreign exchange and the COMEX markets, unlike the US traders siloed in there, unable to do such. And so with full protection of the Fed to allow what they allowed was the issuance, the loaning, the leverage and maintenance of enough branded COMEX casino chips. And what do we call those? It's called COMEX open interest. And really, so they created enough cash-backed chips to overwhelm true price determined supply-demand prices. This was the second leg of the COMEX being launched back from 1974. But just like any casino, unless it's cashed out, COMEX casino chips are worthless outside the casino. So the 2013 effort may have bought them 2 years and temporarily papered over gaping bifurcated chasm. But this time, the competing central banks of China and Russia became unwanted counterparties to this synthetically driven gold price. Both are lying to coordinate swapping their dollars into a historic gold accumulation pivot. Now, we saw that plenty of reports of Russia openly doing it, China starting to step up. And inside the windowless, oxygen-fueled, siloed world of the casino, out of necessity, the games stepped up. And while too obvious when viewed through global liquidity provider eyes, which obviously if you're inside the casino, you don't look out, footprints reveal that the pit managers have been consistently front-running the client-facing table stakes. Hey, well, you've got to maintain a 95% lose ratio, haven't you? And a 5% win ratio and a 95% lose ratio. So pre-positioning ahead of the Fed, ahead of Fed known data, such as a heavily traded CPI report, non-farm payrolls report, the Fed's own FOMC minutes, as we'll see later today, because we're recording this on Wednesday around the fix hour, but also by utilizing they were using delayed client-facing feeds, which when boiled down, really amount to sanctioned wire fraud if you actually boil it down. How often have we evidenced massive house-sized buy or sell orders appear and trade just before a public-facing news release? Multiple times. Many of you who are traders would just say, yeah, happens so regularly. So nobody would do that. Nobody would make a huge bet before a news event. Now, with pit managers, and we call them, this is the agent banks trading on behalf of the Fed, being privy to advanced information ahead of news releases, sharing them and conspiring to link their house accounts. Now, they were called, the CFTC Commissioner Bart Chilton called them cheetah algos, not cheating in the sense, but a fast animal like cheetah algos. Publicly describing them, and he was referring to the high frequency trading algos, was and is common practice to employ them, rewarding agent bank insiders for their own book. That's what's been happening. With these insider activities, while they're illegal, these bank sanctions to intervene in the foreign exchange markets on behalf of the Fed are clearly immune from prosecution. If you know what the Fed has instructed you to do, why would you not run your own book? Front-running data, goodness me, look, that evolved early in the 20th century when horse and dog race results were sent to betting shops by telegraph ahead of being published, enabling you to make the bets, a no-lose bet against the upcoming news. And that was depicted really well in the movie The Sting, I mean, a lot of people will know that movie. So now, if we fast forward to the picosecond world of communications, that 1/1,000,000th of a second or less, we're talking the directional high-frequency trading bots, these cheetah bots, receive and front-run news releases and rig the tables against the human traders. There's no way a human trader can operate at that speed. And it's argued as fair game. If you have the resources to embed your servers inside the clubhouse and have a seat at massive expense, well, what else do you call that? Protection money? If you have the resources, you can protect yourself. So we're drawing some parallels here. The evidence is all there. I mean, JP Morgan, the very same first-tier Fed-sanctioned bullion bank described as a criminal organization, a criminal enterprise by the DOJ, has in all of its trading history never lost money trading gold. That is an impossible statistic if playing on a level playing field. So in our last episode, we also outlined how these casino tools are augmented by some of the other card counting tricks we identified, such as the trade at settlement tools. I mean, if you haven't looked at the episode, we go through in detail. Really, that was where basically cards are surreptitiously sleeved to rinse out table participants and then added back before the decks are audited. However, as we've been drawing attention to, each and every one of these price suppression tools have been figured out by the competing global central banks and sovereigns, all of which are capitalizing on this rapidly closing window, competitively building up gold revaluation accounts before the Fed is forced to. The hair trigger for the Fed to revalue will be if any one of many black swan events could trigger it could trigger other central banks moving first to utilize their gold revaluation accounts, reserve accounts, ahead of the Fed. And they could then aggregate all of their holdings. It would require them really to repatriate gold deposit at the Fed. So in other words, if you need to revalue and you're a foreign bank and you have gold at the Fed, you're going to ask for it back before you do it, aren't you? So really that would happen. So that's not what the Fed wants to see. And tapping into the gold revaluation account facility is simply a matter of selling and immediately buying back the same amount of gold for a realized gain. This would happen without warning and likely be implemented over a weekend. And as we recently discussed, the Fed revaluing US dollar gold would be a preferable option than having to fail to deliver on any more central bank repatriation requests, which would expose the true extent of the 8,133 tons of treasury gold, how deeply they're rehypothecated and have multiple ownership claims on them.
Wow, Andrew, now you've been relentless on drawing our Live from the Vault community's attention to the likelihood, just what you just said here, of a double ownership claims, of all these double ownership claims that this treasury, this treasury gold could have here. Now, this, am I mistaken here, or this really, really looks bad for the Fed?
Yes, Shane, it really looks bad. And bearing in mind, these rehypothecations would be impossible to pay back in physical delivery form because there is sufficient empirical evidence already that we have where they denied the Bundesbank its inspection rights in 2013 after needing years and then asking for years to repatriate just 300 tons of this 8,133 tons of gold. I mean, look, that's sufficient empirical evidence to say, hey, something smells here. There is little doubt that the Fed had already informally tapped into their gold revaluation accounts, borrowing and selling, leasing out treasury gold valued at $42 at market. At best estimate, these gold sales were concluded at the point the IMF finished their gold selling program in December 2010. I mean, you just have to say, there are no coincidences. 2010 is exactly when China opened up the gold market to its citizens. Now, when all was said and done, the official IMF gold sales likely aggregated these interlinked treasury gold conversions at well under $1,000 an ounce. In fact, I have heard plausible estimates that these sales that had commenced during Robert Rudin's 25 years at Goldman Sachs and is running the gold desk there, which he did used to run there, he was openly selling borrowed gold, leasing it out to buy higher yielding treasuries, arbitraging the difference. And so really, if we really look, it's plausible to suggest that some of these bets maybe aggregate well under 1,000, possibly as low as $500 an ounce. How the hell are you going to buy back at market to replace these double ownership claims? So whichever way you look at it, a gold lease is still held on the books of the lessor, but it's nevertheless still a sale, but it ends up double counting the bullion and in bilaterally settled derivative contracts based upon these sales and the scope. I mean, if you add that, the scope of the ownership claims on each ounce multiplies, yet it is still listed as being on the books of the 8,133 tons. But here's the problem. To buy these leases back would have to be conducted at market. And that leaves a hidden multi-trillion-dollar hole. So more immediately, I guess the question I get so often is, where the hell are we now? So given the pace of central bank gold accumulations and the growing arbitrable divergence between the paper gold and the physical gold, and given the heightened geopolitical escalations, it will not be long before global central banks, particularly China and Russia, reveal just how much physical gold backs up their respective currencies. Now, it will be a massive multipolar hegemonic pushback against Biden's win-lose geopolitical ambitions, far more preferable than a hard war. And with the Fed wrong-footed in the gold market, when push comes to shove, that could be over Taiwan, it could be the South China Sea escalations, it could be any one of many things. We would not rule out a move by China and Russia to strategically front-run a well-timed gold price revaluation. Now, the United States relies on the dollar's special status, exorbitant privilege to fund massive public and private borrowings, which they're doing right now. And we just been through a process of it, raising the limits. And now we see the US on the back foot into this situation. And with liquidity flowing out of the casino at an accelerated pace, the time is very close for the Fed to front run a non-friendly upside sanctioned US dollar gold price revaluation. They damn well know that they are vulnerable to it. The pressure to do so is globally driven and increasingly out of the hands of the Fed.
Wow, that's amazing. Andrew, now we're getting a lot of feedback also because the mainstream media is not covering this, but can you give us an update on what's happening in China in particular? Because they're making some big moves, I think, and not being covered.
Yeah, Shane. Again, this is just staggering unless you look at the big picture. I mean, we've been drawing attention to the implications of China opening its gold markets to the citizens. We've done it over the last 2 or 3 episodes, preparing them for war, which is an important point, openly, and that is open information. With the US, I mean, obviously, he's talking about the war with the US, really no one else. And it's also no coincidence that China's President Xi Jinping walks around with a copy of Sun Tzu, The Art of War, in his pocket. I mean, sorry, but I wonder what Biden's got in his pocket. An untimely gold price revaluation will be the ultimate and winning art of war. Footprints in the 10 times larger spot gold market, as well as clues coming from open interest reductions, chip reductions in the casino, point to insiders betting on a higher gold price. Now, just before we conclude, something I will be drawing attention to in early July is not on the radar, and it is the attempted implementation of Basel IV. Now, having been all over why Basel III was and is going to continue to be extremely bullish for gold, and it's only just begun, Basel IV is going to not just consolidate this bullish condition, it's going to exponentially be more bullish as global central banks accelerate their divesting of depreciating fiat currencies. driving fresh physical gold demand in order to hedge against approaching extremely onerous, illiquid commercial banking conditions. Now, Basel III rules were put in place to eliminate massive derivative-driven interbank counterparty risk. Now, gold was the primary focus because trillions of dollars of unallocated gold positions, if you add derivatives, pose the largest counterparty risk. Now, these rules quickly segue into an even stricter Basel IV NSFR requirement, which have commenced actually quietly at the beginning of this year to be implemented over the next 4 years. So there's very little time to mitigate this growing risk, and it is actually a risk for the globe. Now, if Basel IV rolls out unchecked into the 2027 full implementation date, the proposed bank collateral haircuts that are going to divide Europe from the US, there's no doubt this is a US sanctioned move, and Europe is kind of pushing back on this. So we've got a fluid situation here. But by design, this Basel IV what's going to happen is going to deliberately bankrupting some of the first and second tier banks. Conditions that perhaps by no coincidence are already being approached by the current unresolved banking crisis. Well, it's tightening up liquidity. It's tightening up borrowing. It's tightening up exactly what Basel IV is warning about. And this is clearly an incentive to secure physical assets before these onerous World Economic Forum-like conditions roll out. And I plan to expand on how to best position for Basel IV very, very, very soon. It is time to actually action this. And with that warning in mind, guys, let me come back to the only one question that needs answering. How much physical gold and silver do you own?
All right. Basel IV, you heard it first time right here on Live from the Vault. Hey, thank you, Andrew Maguire, for talking gold, and to all of our Live from the Vault community members. Remember, buy physical, buy only physical. Make sure it's backed, 1-to-1. And understand the difference between what Andy affectionately calls the casino paper gold and silver markets and the actual physical gold and silver markets. They're not the same. Don't be fooled. You heard it right here on Live from the Vault. And there you have it. That's all we have for you today on another fascinating episode of Live from the Vault. Please help keep spreading the word about this channel by hitting that like button. Hit it right now. Hit that like button right there. Share this information. And also, you can subscribe if you haven't already done so. Hit that bell if you want to be notified as each episode goes live. And with that, we'll see you right here next time on Live from the Vault. See you then.